These are a strong set of results which evidence a strategy which is working, powered by our transformation initiatives of recent years. Throughout, we've maintained high levels of client satisfaction and high levels of staff engagement. Towards the end of the year, of course, we're impacted by the COVID crisis, and I'm very pleased indeed with the way in which our teams were able to mobilise in response to those challenges and enable us to maintain those high levels of client service. Indeed, I believe we're well positioned to navigate our way through the crisis and indeed prosper in whatever lies beyond. Our decision to maintain the final dividend attests to this confidence.
These are a good set of figures, with our reported profits up 57% to 17.3 million, and our underlying margin increased from 9.3% to 11.7%. The main reason for the improvement was the 11.5% increase in our revenues to 173 million, and all our divisions contributed to this increase. In the prior year, our Investment Management Services division and Charles Stanley Direct both completed a repricing exercise to bring their charging structures in line with markets, and this caused their revenue margin collectively to increase from 64 basis points to 72 basis points, and an actual increase in revenues of 16.4 million. Separately, our Financial Planning division increased their revenues by 19% to £8.7 million. Whilst revenues increased significantly, costs were well controlled. Non-formulaic remuneration increased by 4% or £3.7 million, and there were three elements which contributed to that. First, we increased our marketing spend by 0.9 million as we seek to promote Charles Stanley more aggressively. Secondly, we've recruited more people into the Financial Planning division as we seek to grow that business, and that added 1.8 million of cost. And then the third main contributory factor was a 1.3 million increase in the FSCS levy, which is a cost out with our control, and which I expect to increase further in the current financial year. So with revenues up and costs controlled, underlying profits were up 45.1% to 19.3 million. We had exceptional costs in the year of £2 million, and the main element of this was £3.5 million spent on our transformation programme. I'm expecting 2.6 million of savings from that transformation programme in the current financial year 2021, and expecting it to increase further to 4.5 million of annualised savings from FY22 on. With these much improved profits, our balance sheet has strengthened considerably. Net assets are at 116 million, and our cash position, and we have no borrowings, is now at £93.5 million. Our regulatory capital solvency ratio is up to 189%, so we're in a very strong position. And this has enabled the board to recommend a dividend of 6p, making a total dividend for the year of 9p, a 2.9% increase.
The transformation programme touches every corner of the firm, but I'll highlight three notable initiatives. First, we created a single marketing distribution capability, and that provides a launchpad from which we can begin to accelerate our top-line revenue growth. Second, we've successfully created a single middle and back office, and this allows us to both simplify and standardise what was formerly quite a complex web of operational processes, and this is transforming our productivity. Third, we've entered into bottom-up engagement with those investment teams which were recording lower levels of profitability than their colleagues. Working together, we've delivered a step change, and that has supported the notable increase in the overall profitability of our key Investment Management Services division. Turning to the coming year, I would draw attention to three key focus areas. First, we will continue to invest in financial planning, where we see growing demand from clients alongside our better-known bespoke investment services. Second, there'll be further investment in digital. The success of Charles Stanley Direct shows that we are no digital slouches, but we're determined to propagate that excellence across the firm. And third, there'll be further investment in ESG. Now, there's nothing new in our investment managers' analysis of environmental, social, and governance factors when making investments, But we see growing demand for a focused investment offering centered on ESG, and we will be building this out to client requirements. The near-term outlook is unusually uncertain. Our revenues are impacted both by the level of stock markets and the level of interest rates, which are in turn dependent on the real economy. And of course, it's very difficult to predict where economic activity will be in the months ahead, either in the UK or indeed globally, until there is greater clarity on the path out of the crisis. But should the global economy remain weak, our substantial cash position and strong balance sheet leaves us very well positioned to weather any storm. So we remain very positive for our long-term prospects, and we are maintaining the ambitious course set in recent years.